Okay, well, let's kickstart the Money Show then and bring on board our very first guest, Dilshad Billimoria of Dilzer Consultants. Dilshad, thank you so much for joining us this evening on the Money Show. So, Dilshad, this category, aggressive allocation funds, like I mentioned, it's been seeing good returns, and it's something that's luring a lot of investors as well. But to start with, let's understand the basic. What exactly is an aggressive allocation fund in the first place?
Right. So an aggressive allocation fund basically comes under the category of either equity or hybrid allocation. If it is a hybrid aggressive allocation fund, the equity allocation can go as high as about 65 to 85%. And if it is equity, it is basically investing in underlying equity shares of various other funds. So that's the very simple definition of an aggressive equity or hybrid fund.
Okay, so I think the first comparison that comes to my mind as well is that this sounds eerily similar to a balanced advantage fund or a dynamic asset allocation fund. So why are there two categories then for two very similar sounding investment strategies?
Yes, that's a good question, Mubina. So a dynamic asset allocation fund basically, as the word suggests, invests in various asset classes like equity, gold, debt, real estate, cash. This is not as per the mandate for balanced advantage funds. In balanced advantage funds, the mandate as per SEBI regulation is about 40 to 60% in equity, about 33% in debt, and the rest in between arbitrage and cash. The newer category called the aggressive hybrid asset allocation funds. These are those kind of funds which typically invest between, like I said, 65 to 85% in equity. And therefore, because equity today is the flavor of the season and the markets are doing as such so well, they have gained a lot of importance. So the important benefit, I would say, is the benefit of diversification in an aggressive asset allocation fund with the potential of a downside risk being reduced. So it's not purely 100% equity fund. At the same time, you're cushioning yourself against any volatilities that might occur in the future.
So in a way, Dilshad, would you also say that this category of fund does the job of asset allocation for you? So, we usually say that, okay, the younger you are, put more in equities, and then as you grow older, slowly start trimming down your exposure in equities. Is this doing that job for you then?
Yes, absolutely. So there are funds which internally have certain percentages between equity, debt, cash, gold, and real estate, like I mentioned. And it even helps the investor because otherwise the investor has to keep entering and exiting a fund, and there would be charges like exit loads and taxes. Here, the fund manager is doing it on behalf of the investor. So the investor gets the flavor of various asset classes. So the correlation risk reduces, which is a negatively correlated asset classes, which is fantastic. And it protects the downside. So you at all times, you're ensuring that your money is well spread among various asset classes.
So Dilshad, you mentioned that this year year and a half, when we've seen this category, aggressive allocation, do very well, it's also because equities have done extremely well. And like you mentioned, at least 65% of the money has to be in equities. It can be 65, 80, 85, whatever. Now, markets are already at record high levels. So many are saying that, okay, now we may see some moderation in the markets, etc. Though, mind you, I think up until now, the market seems to have defied every bear call. Is this, when we see moderation in equities as an asset class, what happens to this aggressive allocation fund?
Yes. So in aggressive asset allocation, as the name suggests, the fund manager has the discretion to change the asset allocation dynamically. And this is what helps, especially when the markets are only on a rise, right? So at the same time, the fund manager can change the equity allocation and reduce it if they find that the P's of the markets are really high, or the markets have run up and the valuations are really high. So because of this flexibility, diversification, and reduced volatility, I think that's the reason why these category of funds have gained a lot of importance.
And I think a lot of interest too, because, like I said, the AMFI data does say that almost every month, regardless of what happens to the other fund categories, you do tend to see net positive inflows in both of these categories, aggressive allocation and balanced advantage. So Dilshad, do you think if somebody, let's say, is new to the markets, is just starting to invest in mutual funds, do you think this is a good starting point right now as we speak? Because like we said, equities are already at record high, so they may feel a little hesitant to start their SIP at such high levels, even though as a long-term investor that really should not be something that should concern you, but still for their mental satisfaction, do you think this is a good starting point then?
Well, I would answer that as per the risk profile of the investor. So if the investor is between a moderately aggressive and an aggressive, or even sometimes to some extent a balanced investor, I think having a certain percentage of balanced advantage or aggressive asset allocation or dynamic asset allocation for that matter in the portfolio tends to yield that cushion of returns as well as protect the downside of safety. The percentage would ideally be dependent on the risk profile and the asset allocation that is designed for that investor.
Considering the fact that this fund gives you that downside protection as well, because it has the debt component too, it may be 10, 15, 20%, whatever, would you classify these as being relatively less risky than a large cap, mid cap, or small cap fund?
That's a good question. So, evaluating and analyzing the debt component of a hybrid fund is very important, Mobina, because there again, some fund managers might take the credit risk on those components of the debt portfolio. So it's very important to analyze what are the kind of papers that they're investing in. Is it government securities? Is it corporate bonds? What are the ratings of these corporate bonds? Of course, if some of the fund managers would want to deliver higher returns, they might compromise on credit quality and go for lower rating papers. So I would not say that even though it has a debt component, it is safe. It's very important to evaluate that component of debt and see that there is, the ratings are pretty high, above AAA plus.
Okay, so basically, Dilshad, the manager is also free to invest in whatever rating in terms of the debt. There is no cap as such that you have to invest above W or anything.
No.
Okay, got it. When somebody does invest in this fund, would you reckon, and let's again look at it from the beginner investor point of view only, would you reckon a basket of, a mix of large, mid and small cap funds and debt funds, which may be long duration, short duration, or would you just reckon one simple aggressive allocation fund, which does, the entire job of those 4-5 funds for you?
See, the thing about aggressive allocation is there is no clear-cut benchmark, right? So for an equity fund, we have a clear-cut Nifty or a BSE 200, which is typically followed. And for the debt, we have the CRISIL bond index. When it comes to a hybrid category, there is really no benchmark to, evaluate the fund manager performance. So I would think it's right to have a certain percentage of one's, core portfolio towards asset allocation funds, but have a clear understanding of what would be that weighted average benchmark between equity and debt when it comes to the, investment in hybrid asset allocation funds.